Hello friends. So in today's session, I'll be introducing cost of capital to all of you. Okay. So let's get on with it. Each and every company, in order to finance their day-to-day expenses, they depend on two main sources of income. How much? Two main sources of income. And the first one is called as the owned capital, popularly also known as the owner's funds. And what are the types of owner funds? It can be in the form of equity share capital, it can also be preference share capital, or the accumulated profits, which is also called as reserves and surplus. Okay, and which is the second most important source of income for a company? Yes, it is borrowed capital. Now, this borrowed capital can be in the form of issuing debentures. It can also be in the form of by taking loans from financial institutions, and they can also issue bonds. Okay, so these are the two main sources of income for a company: owner's fund as well as borrowed capital. Fine. Now remember one thing very carefully. This owner's funds or owned capital is also called as the shareholders funds. Okay, moving ahead. Now we will run through some logics building around this chapter. So which is the first logic over here? Nothing comes free for cost. Okay, and when I say this, it is very important for us to understand that everything has its own cost. You are buying a loan, you are borrowing some money from bank. Okay, so the bank charges you interest, so that's your cost, interest cost. Similarly, the owners who are investing money in their own business, they are also having some cost. How? I will explain you in some bit of time. Okay, so for now, nothing comes free of cost, and each and every fund has its own cost. So let's understand what is the cost of owner's fund. Yes, the cost of owner's fund is called as the cost of equity. And what is cost of equity? Cost of equity is nothing but the minimum return which the company could have earned by making investment somewhere else. Again, please read the sentence very carefully. Cost of equity is the minimum return that the company could have earned if it had made investment somewhere else. Let's take up an example. Suppose there are two projects, project A and project B. Fine. Suppose this particular company invested in project A and they earned 10% rate of return. Fine. But after some point of time, they realized that some other company, they invested in project B and they earned 12%. Okay, so they earned 2% more than this company. Fine. So the cost for them is 2% because they are losing a chance to earn extra 2%. Why? Because they didn't invest in project B, they invested in project A. So that is the cost of equity for a company, which is called as minimum return that the company could have earned by making investment somewhere else. Now, which is the second logic? We know that there are two kind of sources for a company to meet its day-to-day expenses. First one is called as owner's fund, and the second one is called as borrowed funds. Now, what is the cost of borrowed funds? As I already explained, we go to a bank and borrow money. But is that money free of cost? No. They charge you interest. So, borrowed funds have interest cost with it. Fine. Now, moving ahead. So, by this diagram, we understand that owner's fund and outsider's fund, that is borrowed funds, they together provide funds to a company, and these funds, since they carry cost, owner's fund has its own cost, outsiders funds has its own cost, and hence the name of the chapter is called as cost of capital. Fine. So moving ahead, we will understand the usefulness of cost of capital. Cost of capital is also called as KC in short form. Fine. So what are the usefulness of doing cost of capital? The first one is, if a business wants to make any investments, it has to make capital budgeting decisions. Okay. Now, how can this investment be done? For this, the company needs funds. For investing into any new project, the company needs funds. And these funds can be raised smartly with the help of a good capital structure decision. Okay. Now, we came across two important words in this slide. One is capital budgeting and the other one is capital structure. Don't worry, as of now, I have made two separate set of videos for this understanding in detail. Okay. So summing up the introduction lecture for cost of capital, all I would say is that cost of capital is referred as the discount rate used in determining the present value of estimated future cash flows of business and eventually deciding whether the business or project is worth undertaking or not. Do not get confused with these fancy terms, as in when we will solve sums, everything will be a piece of a cake for you. Okay. And the cost of capital is also the minimum rate of return that a firm must earn to maintain the market value of its shares. Okay, fine. So this was all about the introductory lecture of cost of capital. If you like the video, please like, comment and subscribe to my YouTube channel. For now, bye bye, take care, good night.